Now, since we already have completed the timeline for year 1 and year 2, so let's go to the entries. So the entry at the end of year 1 is debit cash 400,000. Because again, we received cash as Papa G and credit income, interest income, which is the difference between this after interest of 1,091,259 and this 983,116. And we have the difference 108,143. And again, that is the interest income. And since there is a decrease of notes receivable balance from this to this, the difference, which is 291,857, will be credited to notes receivable account. So that's the full entry at the end of year 1 of Papa G. Now, at the end of year 2, you have to debit cash 470,000 for the principal and interest payment, and then credit interest income again, which is 76,038, which is just the difference of this 767,297 minus 691,259. And then credit notes receivable for the decrease from this 691,259 to 297,297. And that difference is 393,962. So that's the full entry for year 1 and year 2, and the timeline for year 1 and year 2. Now, it's time to go to the selling of the notes receivable on August 1, 20x3. So what will happen first? Now, my technique related to discounting or selling notes receivable is first to make a journal entry, which is simple, which is debit cash, of course, and then credit notes receivable, because you are selling the notes receivable, right? So, logically, you need to debit cash because you will receive cash from the buyer of the notes receivable. And of course, you need to credit notes receivable because you will surrender your notes receivable to the buyer. Okay? Now, to complete this entry, if the cash is lower, so the cash debit is lower than this credit notes receivable, then there will be another debit entry, which is the loss from the discounting or sale of the notes receivable, which is a normal scenario compared to having a gain on discounting. So that's my first step, which is again making this entry. Now, the next step is to put the amounts in this, and let's do that after this. So, let's fill this entry with amounts. So the easiest for me is getting this notes receivable that you're going to give up, or this credit notes receivable here. Okay? So how do we do that? Okay. Since we already have the value of the notes receivable at 1231.20x2, let's get first the interest from 1231.20x2 to August 1.20x3 only, not on 12/31/20x3, because this is already the date of sale of your notes receivable, and this is also already the last date for your notes receivable. Okay? Now, from here to here is 7 months, right? So meaning, you are entitled for 7 months interest, aside from this 297,297. So, let's compute that. So 297,297 times 11%, and we have 32,702.67, which is the interest for 1 year. Now, again, you are not entitled for that whole 32,702.67 because you are only entitled for 7 months. So that amount should be multiplied by times 7 over 12 months. And that will be equal to 19,077. So, your notes receivable that you're gonna give up on August 1/20x3 is this 297,297 and this interest receivable of supposedly 19,077. And the sum of these two is 316,374. Now, the second amount that's needed is this debit cash or the proceeds. So how to compute this? The formula for proceeds is just maturity value minus discount. And we already know that maturity value is 330,000, right? Because that should be the final amount that you are to receive supposedly if you as Papa J had not sold it. Okay? But if we try to break this down, because this maturity value and discount has formulas of its own. So if we try to break down the maturity value, that is principal plus interest. And if we break down the interest, that's principal times interest rate times time. Okay? So let's apply that. So principal is 300,000 plus 300,000 times 10% rate times 1 year. And we have the interest 30,000. So the maturity value is principal of 300,000 plus interest of 30, that's 330,000. Okay? However, for me, it's much better if we use this recent carrying amount of 297,297 plus the interest, which is principal 297,297 times effective rate of 11% times 1 year. So for me, that's much better. Although, it will still result to 330,000. And actually, it's up to you. Because it depends on what is given in the problem. So in our illustrative problem, since we computed for the effective rate, so for me, this is much appropriate. This carrying amount times interest rate times time plus the carrying amount, of course. But if ever, in the problem, there is no mention about effective rate, then you are going to choose this first option, this principal based on the agreement times the nominal rate times time to compute for the interest. Okay? Again, it's up to you because it depends on what is given in the illustrative problem or in the problem that you're going to solve in the future. Okay? So again, the maturity value is 330,000. So we need to compute for the discount already because we have the maturity value already. So how do we get such discount? Let's have that after this. How to get the discount? So that's maturity value times discount rate times unexpired time. So to immediately relate on that, let's go to the substitution of given information in the illustrative problem. Okay? So again, the maturity value is 330,000, right? Times the discount rate, which is given at 14% based on this illustrative problem. And times unexpired time. So this unexpired time is just the number of months from the date of sale, which is August 1, 20x3 to December 31, 20x3, which is the maturity date. It's just like that. Okay? Now, 330,000 times discount rate of 0.14 times 5 months over 12 months equals 19,250. Again, 5 months came from the number of months from August 1, 20x3 to December 31, 20x3. So that's 5 months. So the discount is 19,250. Okay? Which means that the cash that you will receive as Papa G is 330,000 maturity value minus the discount of 19,250, and that will be equal to 310,750. Okay? And since here the debit is much lesser than the credit, so the balancing figure is a loss on discounting of 5,624. And it's very clear that you cannot get this loss amount if ever you're not going to get this debit cash and credit notes receivable. Okay? So that's it. That's the full entry on August 1, 20x3. So let's end this video lecture now to keep this video short. Okay? So in the next episode, let's have a comprehensive problem and let's answer it based on what you've learned in this episode. So again, if you learned, please click like, subscribe, and hit the notification bell to be updated on my next episodes. So again, thank you for watching and see you on the next one.